Welcome to the Q2 Outlook for US Treasuries in conjunction with Trackstar, Investing Channel's proprietary technology that tracks and analyses financial professional investment research. A strong rebound following sharp declines at the end of last year. A dovish shift from central banks and mounting growth concerns combined to allow government bonds to perform well in the first quarter of the year. High-yield corporate bonds also enjoyed their strongest quarter for several years. The dovish pivot from major central banks proved particularly significant, with markets having grown nervous over the prospect of monetary tightening in the US. The heads of both the Fed and the ECB indicated rates would not rise in 2019. Growth and inflation forecasts were also lowered. US 10-year Treasury yields fell 30 basis points over the quarter, reaching their lowest level since late 2017. The 3-month Treasury bill yield rose higher than that on 10-year bonds in March. This yield curve inversion underlines the growing caution among investors around economic growth prospects. While there is some general caution in the market surrounding US Treasury valuations after the recent rally, it is worth remembering that they are still seen as portfolio diversifiers, given their negative correlation with equities. It looks like the yield curve is set to gradually steepen, driven by solid US economic growth, a Federal Reserve willing to entertain inflation overshoots, and a potential shift in its balance sheet towards shorter-term maturities. The Fed has also pivoted into a dovish direction and tapered its expectations for future interest rate hikes. The supply-demand for US Treasuries remains mixed, with the demand side being key to the outright call. The balance sheet is biased to the domestic side, with yields remaining low despite a moderation in foreign buying. The Fed's announcement of an earlier-than-expected end to balance sheet reduction has also been supportive. Looking to credit markets, a still-growing economy, reduced macro volatility and a decline in issuance have been supportive, alongside a decline in M&A volume and renewed focus on balance sheet strength. The US investment-grade sector remains highly leveraged by historic standards, and the late-cycle economic dynamics suggest downside risks ahead. However, a widening spread between high-grade and investment-grade bonds is seen as an indicator of stronger performance in investment-grade bonds. Let's take a look at the technicals and start with the US 10-year. With the Fed on hold rate-wise and a 60% probability of a rate cut this year, the chart looks like a head and shoulders topping formation. These are major topping patterns and can mean a move of some magnitude if the pattern works. All in all, this chart looks very bearish for US interest rates. Additionally, the 200-period moving average is holding sellers up for now, in line with rising momentum. We can see a cluster of resistance at 2.6, and to the downside, the 50-period moving average has provided support to spot at the end of March, as momentum dipped into oversold territory. Skipping to the 30-year, we can see a similar outlook to the 10-year. Over the last quarter, the 200-period moving average has provided strong resistance to moves higher, with momentum range bound close to oversold territory.